The current market is closed today, Saturday, December 20th, 2025. Moderna Inc., trading under the ticker mRNA on the NASDAQ, finished its last active session on Friday, December 19th, at a price of $33.80 per share. This represents a significant intraday surge of $2.85, or 9.21%, as investors reacted to a flurry of late-week developments that have fundamentally shifted the risk profile of this biotechnology giant. While most investors are fixated on the company's struggle to replace its massive pandemic-era windfall, the real story right now isn't just about the declining sales of old vaccines. It is about a massive, high-stakes pivot into oncology and latent viruses that most of the retail market is completely overlooking. While the crowd is busy mourning the 2021 highs, institutional players are quietly watching a massive short interest position that has now swollen to nearly 20% of the float. This creates a powder keg situation where any positive clinical data could trigger a violent upward move, much like the one we saw during Friday's trading session. The prevailing market expectation for Moderna has been one of slow, painful decay. The narrative suggests that without a global health emergency, the company is simply a massive research laboratory with no sustainable commercial engine. However, the reality we are seeing on the tape is far more nuanced. On Friday, the stock didn't just drift higher, it reclaimed key technical levels that had been acting as heavy resistance for months. We are seeing a company that is aggressively cutting costs, slashing its research and development spend to more manageable levels, and focusing purely on the high-probability winners in its pipeline. For those of you who have been using the Robinhood app or your individual brokerage accounts to track this volatility, the recent price action feels like a major trend reversal is attempting to take hold. But before we get ahead of ourselves, we have to look at the macroeconomic pressure cooker that Moderna is currently sitting in. If you look at the recent institutional activity, you will notice something fascinating. While retail sentiment remains largely skeptical, firms like BlackRock and Morgan Stanley have actually been adjusting their positions. BlackRock recently increased its stake by over 3%, even as other major funds like FMR LLC were trimming their exposure. This tells us that the smart money is divided, but the ones who are staying are betting on the long-term viability of the mRNA platform rather than just the next quarterly earnings report. If you were involved in self-investing or looking for investment help through platforms like Schwab Intelligent Portfolios or Fidelity Wealth Management, you know that biotech is often a binary bet. You either get the FDA approval and the stock doubles, or you get a complete failure and the stock craters. Moderna is trying to break that cycle by building a diversified portfolio that looks more like a traditional pharmaceutical powerhouse than a speculative biotech startup. Let's talk about the immediate catalysts because that is what drove the 9% gain on Friday. We just saw a major endorsement from the Coalition for Epidemic Preparedness Innovations, or CEPI, which committed up to $54.3 million to fund a pivotal Phase 3 trial for Moderna's H5 bird flu vaccine. While bird flu might seem like a niche concern to some, the market sees it as a massive validation of the 100-day mission and Moderna's ability to be the first responder for any future respiratory threat. This isn't just about one virus, it's about proving that the mRNA platform can be retooled for any target in record time. For those of you watching the sector through the SoFi trading platform or Interactive Brokers, you likely saw the entire vaccine group move in sympathy, but Moderna's outperformance was distinct. It suggests that the market is beginning to value the platform as an asset, rather than just viewing the company through the lens of a single product. There is also the heavy shadow of regulatory uncertainty. Recently, there has been significant chatter regarding potential black box warnings for certain mRNA products, which has kept a lid on the stock price for much of the late fall. This is where the tension between expectation and reality becomes most visible. The market expects these warnings to destroy demand, but the reality is that the medical community already understands the side effect profiles, and most of these concerns are already baked into the current depressed valuation. When you see a stock like Moderna trading near its 52-week lows, despite having billions in cash on the balance sheet, you have to ask yourself if the fear has finally outrun the facts. The company is currently sitting on a cash pile of approximately $7.5 billion, which gives them a massive runway to fund their oncology trials without needing to return to the capital markets for a dilutive share offering. Speaking of oncology, the Merck partnership remains the single most important long-term driver for this stock. The INTerpath.009 trial, which is evaluating their personalized cancer vaccine in combination with Keytruda for lung cancer, is a massive undertaking. If this succeeds, it wouldn't just be a win for Moderna stock, it would be a fundamental shift in how we treat cancer globally. Imagine a world where your specific tumor is sequenced and a custom vaccine is printed for you in a matter of weeks. That is the reality Moderna is building, while the expectation of the market is still stuck on the idea that they only make respiratory shots. This disconnect is exactly where the opportunity lies for those who have the patience to look beyond the next 6 months. Use the comments section below to tell me how many shares of Moderna stock you currently hold, or if you are waiting for it to drop back into the $20 range before you consider an entry. The technical setup here is also worth a deep dive. For much of 2025, Moderna has been stuck in a punishing downtrend, characterized by lower highs and lower lows. However, the recent reclaim of the 50-day moving average is a signal that the momentum might finally be shifting. We are seeing a significant increase in daily trading volume, which often precedes a major breakout. Institutional investors often use Fidelity brokerage or interactive broker platforms to execute large block trades, and when you see volume spikes like we did on Friday, it usually indicates that the big fish are starting to reposition themselves. The short interest is the real kicker here. With nearly 20% of the float shorted, any piece of positive news regarding their CMV vaccine or their melanoma trials could force those shorts to cover their positions simultaneously, creating a vertical price spike. Now, we have to address the business model because it has undergone a massive transformation. Moderna isn't the same company that it was 2 years ago. They have slashed their commercial headcount and narrowed their focus to just 10 prioritized programs. This lean approach is designed to get them to cash flow break-even by 2028. For an investor using online investing tools or looking at investing sites, the wait until 2028 might seem like an eternity. But in the world of biotech, a company that can fund itself for 3 years without needing more cash is a rarity. They have also successfully onshored much of their manufacturing, which should help improve their gross margins, which were heavily compressed during the rapid scale-up and subsequent scale-down of the pandemic years. Let's look at the broader sector momentum. The healthcare sector as a whole has been under pressure due to policy headwinds and uncertainty regarding government pricing negotiations. However, Moderna's unique position as a platform company gives it a different risk profile than a traditional small molecule drug maker. If you are managing your own intelligent portfolio or using a SoFi robo-advisor, you might notice that biotechs are often uncorrelated with the broader S&P 500. This makes Moderna a potential hedge if the general market starts to feel toppy. Of course, the risk remains that their RSV vaccine, mRESVIA, is facing stiff competition from established players like GSK and Pfizer. The initial sales numbers for mRESVIA were underwhelming, which is part of why the stock has been so heavily penalized. The market expected a plug-and-play success in the RSV market, but the reality has been a much tougher commercial grind. Despite these challenges, the long-term outlook is anchored by their goal of having up to 10 product approvals by 2028. This includes their combination flu and COVID shot, which could significantly simplify the seasonal vaccination process for older adults. If they can capture even a fraction of the seasonal flu market, it would provide a steady, predictable revenue stream that would replace the lumpy, unpredictable COVID sales. When you are looking at online investing options or deciding which stocks to put into your individual brokerage, you have to decide if you believe in the mRNA platform as a whole. Is the technology fundamentally better than traditional vaccine methods? The speed and precision would suggest yes, but the commercial adoption is still an open question. Institutional activity in the last quarter shows that while some funds are exiting, the ones that remain are concentrated. Vanguard and BlackRock remain the largest holders, providing a level of stability to the shareholder base. We also saw some interesting activity from smaller, more specialized healthcare funds that have been picking up shares on the dips, which suggests that the smart money is starting to see value at these levels. If you are using Fidelity Trading Platform or the Robinhood app to watch these institutional moves, you know that following the big money isn't a guarantee of success, but it does provide a sense of where the floor might be. Currently, the floor seems to be holding firm around the $26 to $28 range, and Friday's move to $33.80